There are currently more than 4,000 different exchange-traded funds now listed on US markets today. 4,000. And if you've ever opened a brokerage app and tried to figure out where to actually put your money, you already know what that number feels like. It feels like drowning. Here's the uncomfortable truth the ETF industry doesn't want beginners to hear. You need 3, not 30, not 12, 3. And once you understand why, you'll realize that almost everything else being marketed to you is either unnecessary or actively working against you. Let's start with what an ETF actually is, because the term gets thrown around constantly without explanation. An exchange-traded fund is a basket of investments, stocks or bonds, bundled together into a single security that trades on the stock market just like an individual share. Instead of buying one company and betting everything on its performance, you buy a slice of hundreds or thousands of companies at once in a single transaction, often for less than the price of a nice dinner. If one company inside that basket collapses, the impact on your overall investment is small because it's just one piece among thousands. That built-in shock absorption is the entire reason ETFs replaced individual stock picking as the default starting point for most new investors over the last 2 decades. Now here's where beginners get overwhelmed, because ETFs exist for literally everything. There are ETFs for artificial intelligence companies, for uranium mining, for companies that pay dividends, for the exact opposite of the stock market, in case you want to bet against it, for triple-leveraged bets on single stocks that can lose 80% of their value in a bad week. The industry has turned investing into an endless menu, and endless menus don't help beginners, they paralyze them. So let's cut through it. The 3 funds you actually need cover 3 simple categories, and together they represent almost the entire investable world. The first is a US Total Market, or S&P 500 fund. This single fund gives you ownership in the largest publicly traded companies in America, or in the case of a total market fund, thousands of US companies including the smaller ones. This is your foundation. Historically, broad US stock market funds like this have returned around 10% annually over long stretches of time, though of course, past performance never guarantees future results. The expense ratio on funds like this is typically around 0.03% annually, which is about as close to free as investing gets. The second is an international fund. Here's a stat that surprises almost everyone the first time they hear it. The United States makes up roughly 60% of the entire global stock market. That means if you only own US stocks, you're deliberately ignoring the other 40% of the world's public companies, including entire economies in Europe, Japan, and fast-growing emerging markets like India and Brazil. An international fund closes that gap in a single purchase, and in some recent years, international markets have actually outperformed the US, which is exactly the kind of thing that makes diversification worth the mild inconvenience. The third is a bond fund. This is the piece beginners skip most often, usually because bonds sound boring compared to stocks. But bonds serve a completely different purpose in your portfolio. They tend to be far less volatile than stocks, and they often hold steady or even rise when stocks are falling. A total bond market fund gives you exposure to thousands of government and corporate bonds in one purchase, and it acts as a shock absorber for the inevitable years when the stock market drops sharply. That's it. Total market, or S&P 500. International. Bonds. 3 funds, and depending on your age and how much risk you're comfortable with, you simply adjust the percentage you put into each one. Someone in their 20s might lean heavily towards stocks with only a small bond allocation, because they have decades to recover from downturns. Someone approaching retirement typically shifts more weight toward bonds because they can't afford to wait out a multi-year market crash right before they need the money. Now let's talk about why more funds almost never means more diversification, because this is the trap that catches so many beginners who think they're being sophisticated. If you buy a total US market fund, and then also buy a technology sector fund, and then also buy an S&P 500 fund, you haven't built 3 layers of protection. You've bought overlapping exposure to the same handful of massive companies 3 separate times, while paying 3 separate expense ratios for the privilege. Diversification isn't about the number of funds sitting in your account. It's about how much genuinely different exposure each fund adds. Once you own the total market, international stocks and bonds, additional funds usually add complexity without adding meaningful protection. A portfolio with 15 overlapping funds isn't more sophisticated than one with 3 well-chosen funds. It's usually just more confusing to manage, harder to rebalance, and more expensive to hold, without delivering any measurable benefit in return. Which brings us to expense ratios, the quiet cost that determines more of your long-term outcome than almost anything else, and yet gets almost no attention from beginners. An expense ratio is the annual fee a fund charges, expressed as a percentage of your investment. The difference between a fund charging 0.03% and one charging 1% sounds tiny. On $10,000, that's a difference of about $97 a year. That doesn't sound dramatic until you let it compound over 30 years, at which point that seemingly small fee gap can quietly consume tens of thousands of dollars that should have been yours. Imagine 2 people investing the exact same amount every month for 30 years, earning the exact same market return before fees. The only difference between them is a 1% annual fee. By the end of that 30-year stretch, the low-cost investor can end up with tens of thousands of dollars more, simply from avoiding a fee that felt too small to matter on any single statement. Low-cost, boring funds beat flashy, expensive funds far more often than the marketing suggests. Here's what I'd specifically avoid as a beginner. Leveraged ETFs, the ones promising 2 or 3 times the daily return of an index, reset every single day, and are built for short-term traders, not long-term investors. They can lose the majority of their value during a rough stretch and never fully recover, even if the underlying index eventually does. Single-country funds betting on one specific economy concentrate risk instead of spreading it, and funds charging expense ratios above 0.5% need a genuinely compelling reason to justify the extra cost, because that reason rarely exists for a beginner's core portfolio. It's worth saying plainly that none of these funds are inherently bad. Leveraged and single-country funds have legitimate uses for experienced traders who fully understand the mechanics and the risk. They're simply the wrong tool for someone building a first long-term portfolio. I want to be clear that this isn't personalized financial advice, and your specific mix should reflect your own timeline, goals, and comfort with risk. But the structural point stands regardless of your personal numbers. The goal isn't to find the cleverest possible combination of funds. It's to own a small number of broad, low-cost funds, keep contributing to them consistently, and resist the urge to constantly tinker with a portfolio that was already working. If you're starting from zero, here's the simple version. Open a brokerage account. Choose a total market or S&P 500 fund as your core holding. Add an international fund to cover the other 60% of the global market. Add a bond fund sized to your age and risk tolerance. Set up automatic contributions so you're not relying on willpower every single month, since the investors who succeed long-term are rarely the ones with the best stock picks, but the ones with the most consistent habits. Then, and this is the hardest part for most people, stop checking it every day and let 3 boring, unglamorous funds do the quiet work of building real wealth over time.